So let's let the purpose of this video be to show the basic mechanics of once you have well-documented assumptions in terms of how we pull those into then the income statement and the cash flow model. So I'm using the problem that I created earlier that has all of these assumptions documented up here, and the word problem goes something to the effect of make a $10 million initial investment for a piece of equipment that lasts 8 years. It has no salvage, can be resold for $500,000 when the rate is 10%, and it would yield them the following new revenues and new costs. So let's go ahead and build an income statement. And again, the reminder here is we're trying to get expert at how finance people think about doing income statements. So the first thing we want to know is that it's first revenues that are going to be our first line as per always. If we could only spell that correctly. Then when we have our expenses, our first set of expenses then will be cost of goods sold. After cost of goods sold is gross margin. After gross margin will be SG&A. After that will be EBITDA. After EBITDA will be depreciation. And after depreciation will be EBIT. After EBIT will be interest expense. I'm having a very difficult time typing today. And then EBT. After EBT will be tax. And then finally net income. So that's the basic structure that we have to memorize. The same way when we have our cash flow model, we've come to memorize that we have periods, cash flows in, cash flows out, cash flows net, present value, NPV, and then IRR. So it's the same basic idea in terms of understanding what the basic elements are. So I'm going to format this just a little bit. Alt-H, F-A. I'm going to center it across the selection horizontally. Put a nice box around there. And now I'm ready to start wiring it. So our revenues will soon be equals to the 4 million. Because I've got that laid out well, now I can go ahead and just copy and paste that all the way across. And then I see that I get an updated reference point. Cost of goods sold in this case is going to be equal to my revenues times my cost of goods sold as a percent of my revenues. So I use that basic formula. And now each of these categories is just a simple previous minus the one that's adjacent. So I've got my basic gross margin calculation, and that will also be repeated all throughout. The screencast-o-matic creates a lag in Excel that doesn't please me, slows me down. Same thing will be true then of SG&A. In this example will be a percent of our revenues. And then that too is going to lead us to another subtotal for EBITDA. So I'll put a little line there and then just subtract off the gross margin, take away the SG&A. Now, depreciation expense can be a little bit different because what we're going to do is assume straight line, and so we'll make some fixed references. So the formula will be initial investment with an F4 minus salvage value, also with an F4, close the parentheses, divided by useful life, also with an F4, and that should give us our annual depreciation expense, and that will be a constant all throughout the project. That too is going to lead us to another set of baseline subtotals. So we'll go ahead and take the EBITDA, subtract off the depreciation expense, and we're a little bit too far. Come on, screencast. Here, maybe if I slowed down a little bit, it would help. Interest expense is just going to be a point and a reference within the same column column to the interest expense that could be there. And you notice the only thing that should pop up will be the $500,000. And then EBT is also going to be a rolling subtotal. Screencast-O-Matic and I are just not getting along today. So we're going to do this and this. Format those. You know what I mean? It's refusing to take my commands. Many times. There we go. Alt-Han solo. And then we need a line underneath here. We got a superfluous 0 at the end. Alright, we're almost there. Earnings before tax, just another one of those little subtotals. Don't need this line here, so we'll get rid of it. Now tax, this is where a lot of students run into difficulty because they forget that taxable income times tax is the simple and most effective way to calculate the tax rate. And then our last one will be net income is taxable income minus tax alt HBU. Lets us finish it off. So at the 6-minute mark, I'm going to go ahead and stop now so that you can see the income statement. And then I will do another one with the model.